Okay, well, I think it is time that we begin our webinar today. Welcome to Alaska and to the webinar for Dynamic Brands hosted by Kodiak Trust Company and Accuvest Global Advisors. Eric, if you'll turn the page. So Kodiak Trust Company is an Alaska trust company. We are an independent entity, so we are not connected with any particular investment house or attorney group or anything, and that allows a lot of autonomy for both the trusts that we have as well as investment advisors to use Kodiak Trust Company to provide trust services for your clients without risk of or a feeling that oh, they're connected with an investment house, they're going to steal my clients. We are independent. Our specialty is domestic as well as international clients. And our goal really is to provide for our clients and for the investment advisor an opportunity to have the structure taken care of so that you know that things are going to be well cared for, both in an ongoing inheritance tax as well as if something happens to your client. We have a lot of experience in the international as well as domestic, having run trusts in both Switzerland and Bahamas and overseas, and are very familiar with both the Latin American culture as well as Spanish speaking, which is a great benefit because many times clients want to understand the trust in their own language. So that's a brief introduction into Kodiak Trust Company. I am located in Anchorage. Eric Clark and Accuvest Global Advisors are one of the investment advisors that we have worked with for many years. And this particular strategy we have used for our trusts, and we recommend it heartily. I've known Eric for quite a few years, and I will go ahead and turn the time over to him to introduce himself and the fund. Thank you, Eric.
Thanks, Jeff. Appreciate it. Thanks, everybody, for joining me. Happy Thursday in the summer. I hope everybody has some great travel plans. I know I'm pretty pent up. I can't wait to get to Tahoe later this month. You know, just to start, most people, when they hear you've decided to start a new equity strategy, they would probably say that you have to have your head examined. There's 5,000-10,000 different options to choose from. Everything has probably already been done. And while that's generally, I think, the case, there's, a little bit like restaurants, there's a lot of restaurants, but there's always room for another good one. And the reality is, with 28 years experience, I realized that there were a few things that were missing, and there were a few things that bothered me about active management in general. And here's a quick fact for people. I mean, everybody knows, they've seen the stats. About 30% of active managers beat their benchmark on a regular basis. So, that's a little bit misleading, because if there's 1,000 funds in every different style box, you still have plenty of funds to choose from that have had the opportunity to outperform. But the most interesting part of that statistic is, if you were one of the funds that did outperform over a 3-year period, the chances of you outperforming for the next 3-year period are like 5%. And so I was always mystified by this ability of the smartest people to sometimes outperform and sometimes underperform. And in 2015, I just had one of those epiphanies that I just needed to create something. And if anybody knows me, they kind of know that I like to build and fix things. And I looked at the active management world and I said, if I were going to create the perfect strategy on the equity side, and we know perfect is a synonym for frustration because perfection doesn't exist, but if I were to create something that was close to perfect as I could, what would that strategy look like? And so I spent a lot of time whiteboarding, and the product of that was this dynamic brand strategy. So I'm super excited to go into it. We've had great success kind of telling this story. It's a story that advisors and individuals instantly resonate with, because as you can see from these logos, in many cases, we have an emotional connection to a lot of these great companies. And so the first way that I love to tell the story of this brand's approach, and it's very similar to a Peter Lynch know what you own type of strategy, is to have people watch this video that we created. It's one of those 1.5 minute animated videos, whiteboard videos, and most of the advisors that are in the fund now use this video to have a conversation with clients. So I think it's kind of an important, interesting place to start, and then we can jam through some of these slides.
Large Cap Investing 101. First, a few facts. U.S. investors have what's called a home bias. That means their portfolio is always overweight U.S. stocks and U.S. bonds. So whether we like it or not, our investments and our prosperity are tied to the U.S. economy. So what really drives the economy? Household consumption drives the economy. Roughly 70% of the U.S. GDP, or $15 trillion, comes from consumers spending on what they want and what they need. That's a powerful and predictable theme to anchor your portfolio to. The story gets even better. By our estimates, the global consumption theme is a roughly $44 trillion investment opportunity. Why? Because most major economies are in some ways anchored to household consumption. Billions of people spending trillions every year. So what drives our consumption patterns? Brand loyalty is a key driver of consumer behavior. So let's connect the dots. Our home bias never changes. Our investments in large cap companies are a proxy investment in the U.S. economy. The primary driver of the economy is household consumption. The primary driver of purchase decisions is brand loyalty. The conclusion seems pretty clear. If consumption drives the economy, shouldn't the most powerful brands be driving your portfolio? To find out how to get a dedicated allocation to the brands that matter most, ask your financial advisor or contact us directly at globalbrandsmatter.com.
So I think that's a really good kind of commercial, and if you anchor to a large growing thematic like consumption, it's 40+ trillion a year, and you do it through investing in the leading brands that are resonating with consumers across all these consumer spending categories, and you give yourself some flexibility. To us, you just have a better opportunity to be one of those managers that can outperform. If we outperform on one 3-year period, I think because of the thematic and the flexibility and the anchoring to brands, we have a much better opportunity to outperform and make that statistic, kind of work in our favor. So, let's take a look at, the holy grail of investing to me is just if you can provide attractive returns, and attractive to me just means better than the market, but you can do it with a smoother ride. That's really what advisors and clients want. And so that was the overarching goal when we started this strategy in 2015, when we started this project. And in order to do that, you have to do a couple of different things, and flexibility is at the core of that, which is why dynamic is in the name of the strategy. So first, just a reminder, why the global consumer. Every major economy is driven by consumption. 60% of world GDP is households spending money. And it's obviously pervasive in the US. America is a consumption-driven economy. Consumerism is at our core, and 70% of the economy is consumption. So, intuitively, if you're a consumer economy and you're out of recession more often than not, and consumers continuously like to spend money in good times and bad, that's probably a pretty interesting portfolio to be, kind of in somebody's holistic overall portfolio or allocation. And it's important. This is not just discretionary and staples. This is what we call lifetime spending, from Pampers all the way to Botox and hip replacements. That's our universe from which to choose. And that's really important as we go through the investment process, because this is much more broad and diverse than just buying a consumer discretionary ETF or a staples ETF. Here's a little fun fact. I think if I asked people, if you had to guess from the beginning of the major sector ETFs, December of 1998, which sector do you think would be the best performing relative to the S&P? And I think most people would guess technology, which is usually a pretty good guess. Certainly the last 12 or 13 years, tech has just dominated. But ironically, and not so illogically, consumer discretionary, and I'll use XLY as the proxy for that, has actually been the top performing sector since 1998. Now that's 22 plus years. To me, that's pretty good data that shows consumer dedication is probably warranted in a portfolio. And here's the irony: most people don't have any dedicated exposure currently, which is why we decided to create this strategy. Interestingly, the consumer discretionary sector has the best beat rate versus the S&P on a yearly basis at about 68% of the time. Technology only has about a beat rate of 50%, and there's 3.5 times more money in ETFs that are technology focused rather than consumer. So by no means is investing in the consumer and retail and lifetime spending a crowded trade. And again, most people don't have it in the portfolio, which is really the opportunity for someone to get right sized to that opportunity. The next question would be, okay, I believe that I need to own some consumer, but why brands? Why should I anchor to the brands as the way to get that exposure? And a lot of this, you're going to hear more and more about something called intangible assets. I consider it to be a kind of a new asset class, similar to ESG. The reality is 90% of the S&P 500, their total assets aren't tangible anymore. They're intangible. And those are things like patents and brands, customer data, software, et cetera. So if you're investing in the S&P, let's just say you're investing in the S&P 500 via an ETF, one, you're only about 22% exposed to the consumer traditionally, even though 70% of the economy is consumer. And you're probably not getting the intangible assets and the brands that you should be to a large degree. And there's some real value to be had there. And I have a few proof points in there. But first, I want to show you an example of a real intangible asset and a moat, using Nike as a great example. This is a great chart from Hedgeye Risk Management they recently put out. Nike spends about $13 billion a year on endorsements. And talk about an advantage to get your name out to very popular influencers across all sports categories. Just as a way of perspective, Under Armour spends about $330 million a year. Adidas spends about half of that with Nike, arguably more focused, certainly than Under Armour. But Nike has a massive advantage that compounds year after year because of how much money they spend on endorsements. So, wherever you look, you're always going to see that Nike swoosh. And that does sink into your psyche a little bit and help with your purchases when you decide to get products that Nike has. A lot of people will they haven't really connected the dots to, well, intuitively, I know that if you have a great brand, you're probably going to get more of the consumer wallet. But I wanted to put this into some perspective on maybe how it works. So if you have an emotional connection that kind of is long lasting, that tends to foster your loyalty to that brand. And that tends to want you to spread the word and tell your friends and your family. And that tends to take on a life of its own and brings in new brand loyalists, which also offers the company and the brand to have some great pricing power, which creates great network effects and economies of scale, which allows brands to lower their unit costs, and that overall increases their profitability. And we know profitability is linked to stock price performance. So the benefit of having a competitive advantage and increasing your market share and having better metrics like free cash flow and revenue growth and ROICs and all those things all of those things rolled together tend to give you great stock performance relative to your peers and relative to the market. And that's what we can show with brands. Here's a third-party validation of that. Brand Z and Cantor Media is a research firm. They used to be part of, they're a spin out of WPP, the largest advertising firm in the world. These folks do amazing work on brand value, and their work over, since 2006, going over 5 billion data points with 3.9 million consumer interviews, discussing over 18,000 brands across 500 categories and 51 markets, tells you that their top 100 brands has a pretty good history of spanking the market over the long period of time. And the most relevant, the strongest, the most powerful brands, what I consider to be called mega brands, they have an even better chance of outperforming. And here's the fun. Not only do they tend to deliver better returns, they tend to be more resilient in difficult times, and they tend to recover more quickly. So as an investor, it's really nice to be anchored to something that's stable and predictable, that you understand, with names that you recognize and love, particularly when you know that the long term says that these companies tend to outperform a basic index. And that's really what we learned and knew going into the creation. So we have a little bit of a secret. Obviously, we're trying to tell that secret, that this group of businesses really does have great long-term return potential. This is just a chart that shows the brands fund with Rational that we sub-advise. We took this fund over October 17th of 17. Since then, we have annualized about 700 basis points over the S&P, and much more over the All Country World Index, and even over the consumer discretionary sector. We got about a 300 basis point lead there, with about 20% less volatility. Now, most people would say, gosh, why would you put a competitor, the XLY or any ETF, on your slide deck? And my view is, I know that some people only use ETFs in a portfolio, and I respect that. And if you're going to get some consumer exposure, I would rather you have an ETF, if you're an ETF only user, than not have anything at all, because this is a very powerful theme, and these things tend to outperform. We just think the fund that we run and the SMA that we run gives you a much smoother ride along the way, and it gives you much better diversification to the global consumer spending theme, because we do it across sectors. Now, the flexibility is really important. That's part of the reason why we think we can give people a smoother ride. As you know, the business cycle is boom and bust. Sometimes things are great and the market's quiet and volatility's low. Those are, Goldilocks times. But then sometimes things happen, global pandemics, currency crisis, things like that. And sometimes to smooth the ride, sometimes you don't want to be fully invested. Sometimes it's not prudent to be fully invested. And the reality is our industry does a really poor job at giving a manager flexibility. They tend to be very style box set or stubborn. They tend to run fully invested at all times, and that feels good until it doesn't. And so when we created the prospectus and the process, we just said we want lots of flexibility to adapt to whatever the market throws at us, because you never know what the next correction or bear market is going to look like. But if you can hold up to 40% in cash, or you can pivot from some offense to some defensive brands like consumer staples and healthcare companies, and even own bonds in a portfolio, you're probably going to give people a smoother ride so they don't get that seasick feeling and panic sell at the wrong time. So let's switch now into the consumer, because obviously if we're going to be a consumer dedicated investor, we want to know what the consumer looks like currently from a health perspective and from a balance sheet perspective. This is a great quote from Michael Sembalist. He's a strategist at JP Morgan. I really respect him and his work. Recently in July, he said, in the US, for example, household debt service ratios are close to the lowest levels in 40 years. suggesting a sustainable expansion in consumption. And at the end of the day, not only do we know consumers have the potential to spend, but now they have a capacity to spend more because their balance sheet is healthy, their sentiment is high, and this is a chart that shows their household net worth as a percentage of disposable personal income. Because of all-time highs in equities and their home price highs, the global wealth effect is really in full steam, and that's not just in the US. And so generally, when you feel flush with cash and you have job security, you're pretty inclined to continue spending, which benefits what we do. This is a great one also from JP Morgan. This talks about wages, and particularly the low income wages are now rising. So the people at the lowest income spectrum are getting a wage boost. And we know historically that cohort, when they do have extra money, they tend to spend 2/3 and save 1/3. So there is some particularly significant tailwinds to wages rising or being, flat to doing well for higher income brackets. And again, that just spells greater consumption tailwinds. Now, again, household debt, if you looked into, if this was 2008, 2007, I would be singing a different tune. Household balance sheets were stretched. They were leveraged, people flipping houses. They were really, really in a bad, particularly way, which not surprisingly, consumer discretionary stocks tended to suffer over that 2007 and 2008 period, but staples did pretty well. So we do have a great opportunity to pivot from offense to defense if the consumer balance sheet gets really stretched, but we see no evidence of that currently. Now, if you look at the consumption components, the services part of the economy is and we are a service economy, so it's a big chunk of the overall component. That's still slower to respond and recover. So we certainly have some exposure there as a mean reversion opportunity. But in most cases, retail spending and all the components have kind of, they fell off a cliff when the pandemic started and the lockdowns happened. Then they went vertical, and now they're in the process of normalizing. And we still think there's a way to go for some services, particularly as some of the COVID Delta, cases start to peak. And then lastly, we have, the personal savings rate is still elevated. Net, long term, it's been about 7.5%, when as high as over 30 in lockdowns. But because of all the stimulus, fiscal and monetary, there's still over $2 trillion worth of excess savings that needs to be kind of worked its way through the system. And that's not going to happen overnight. So the benefit to investors like us and owners of the fund or the separate account, you have about a 12 to 24 month kind of tailwind for excess savings that starts to go back to normal, and that only does so by consumer spending. And then I was amazed by this. There's still $4.5 trillion of money sitting in money markets that are literally earning nothing. So we think that's going to be a benefit to the bond market and to the equity markets. Although, bonds with interest rates where they are, we certainly think there's a lot more opportunity in equity land than in bond land, but we understand people own both. So now let's just close out with the actual dynamic strategy. If you're going to anchor to anything, you need a dedicated universe from which to choose. And so the first part of this process back in 2015 was at Accuvest as a group, we created the Alpha Brands Consumer Spending Index. And that's 200 companies that we think are the most relevant brands across all the important spending categories, also including what we consider to be consumption supply chain industries like Boeing, that manufactures planes, and semiconductors that are the brains of all the consumer products that we use. And I won't go too much into the construction, but suffice to say, it's a very rigorous process that gets us to 200 great businesses that allow us to invest in the thematic of consumption wherever we need, whether it's a bullish or a bearish perspective. And we update that every December because consumer habits change and new companies come on stream over time. Now, the index, since we started in 2015, like most indexes, we created a back test. September 26th, I believe, was when we kind of went live with calculating the index. So that's that dotted line on here. To the left is a back test, and it tells you that the brands index has outperformed. But in real-time calculations, the brands index has continued to outperform the market. So we do think we have a better S&P 500 that's just much more focused on consumer names than the overall index. And naturally, you would want the index to outperform the market, and you'd want the brand's strategy to outperform the index over time, and I'll show you that in a minute. But what's interesting about the index and the strategy is that it's a combination of two different kinds of brands. Roughly 75 or 80% of the dynamic brand strategy are what are considered to be kind of mega brands. That's at the top of these 10-year returns. Those are stable, predictable, high quality global franchises that are dominant in their category. The returns that these companies have generated relative to the market over 10, 20, and in some cases even 30 years is pretty staggering. And so, the bulk of, we kind of consider the strategy, the bulk of it is these stable, predictable growers. That's the foundation of the house, if you will. And then, the trim around the house would be these emerging mega brands where I show you the 3-year numbers. And those are disruptors and innovators in important consumption categories that have just come onto the market, in a fairly, recent 3 to 5 year period. And we show the massive outperformance of some of these great companies. And we own a lot of these businesses as well. So when you combine mega brands and emerging mega brands, it's a really compelling index as well as an overall portfolio. And again, we've outperformed the market by about 700 basis points. So combining those two seems to be working pretty well. Now, the name is Dynamic Brands. And so I want to kind of finish with the risk management part and then show you some portfolio information. But we use this as a, red light, yellow light, green light approach, because if your goal is to smooth the ride, sometimes you need to put the brakes on a little bit or put some speed bumps, if you will, up. And a lot of things could make us do that. We spent a lot of time on the macro market, on the technicals of the market, on the breadth of the market, and on corporate fundamentals. And so when all of those things seem to line up a little more cautious or bearish, we'll tend to hold a little bit more cash, add a little more defensiveness to the portfolio, and wait for better opportunities on a pullback. And over time, I'll show you the metrics that's really aided the portfolio's ability to be, a much lower volatility type of strategy than most of our peers. So strong alpha or excess return, lower beta 0.88. And this is a Morningstar chart that just shows all of the typical metrics. When the market goes down, we tend to go down 70% rather than 100%. But when the market goes up, we tend to go up more than the market. So, that's kind of that northwest quadrant that most people certainly look for. The how we do it is probably the most important part. I'll just hit the process very quickly. There's a couple of things that are very unique about what we do. Again, we can't stray from the brands index. That's number one. Number two, though, we do a lot of style factor analysis. And before we even get into the stock selection, I use the phrase, that from Charlie Munger: if your job is to catch fish, it behooves you to know where the fish are in the lake. And we use some radar that allows us to know what exactly is driving returns currently in the market. Is it large over small? Is it growth over value? Is it international over domestic? Is it high quality businesses and balance sheets versus low quality? Because once we understand that information, then we can go into our brands index and screen for those kinds of businesses. And that really gives us a leg up to know, to sit at the right part of the lake to start doing the stock selection. And like I said, roughly 70 or 75% of the portfolio tends to be those stable, predictable global leaders like a Costco or a Nike or a Visa or an Amazon. And then the other 15 to 20% tends to be into one of two baskets. Those innovator brands, they tend to be, much higher revenue growers, tend to be much more volatile. So they tend to be smaller weights. And that's the way we risk manage this portfolio. And then there's some tactical trading opportunities, particularly last year when the markets are really volatile. That just means that daily trading ranges are wider, which means that there's a lot of uncertainty. But when there's a lot of uncertainty, there's some opportunities to do some short-term active trading that can add a lot of value while the portfolio is either going sideways or going down because the market's having some trouble. So when you combine all three of those, you get a really interesting, 30 to 35 stock portfolio. And then the last step, obviously, is deciding how much risk we really want to take. And that's based on our kind of risk dashboard that we talked about with the red light, yellow light, green light approach. So here's the portfolio currently. And in one allocation, an investor is getting so much opportunity to be exposed to really important themes like e-commerce and mobile payments and athleisure and EV auto adoption, along with normal day-to-day items like fast casual dining and leisure travel, streaming, video, corporate computing, and then some interesting ones like connected fitness with Peloton, 5G adoption, general merchandise shopping. So this really is a, my life of spending and consumption all rolled into an investment opportunity. And what better hedge can there be to my spending across all of those categories than investing some of my money in the brands that are winning all of our wallet share and mind share. And so this tends to be a very know what you own so you can sleep at night portfolio. If you look at these, Amazon and PayPal and Nike and Chipotle, which had monster numbers a couple of days ago. And then there's some interesting names that you might not know, like RH Restoration Hardware, which is the biggest holding in the strategy currently. They are in the process of becoming the global brand for luxury home furnishings, but they're also blurring the lines between hospitality and retail, creating amazing galleries for people. And we still think that stock has massive upside. And so, you get these interesting mega brands, but you also get these interesting innovators like an Etsy or in a Peloton, which we think has massive opportunity on the connected fitness side. They just signed a deal with United Healthcare to allow UNH subscribers to be able to get access to their app. So we think there's some really interesting, kind of lifetime spending brands that most people don't ever talk about. And so you're going to get some names that are also in other funds or ETFs, but then you're going to get other names like a Caesars Casino or an RH or a KKR and Blackstone for the investment in private equity and alternatives as interest rates rise. So 31 names currently, very diverse across different sectors, but certainly very overweight the consumer discretionary sector because we're anchored to consumption. And when we feel cautious, we'll tend to lower that discretionary basket and then raise up the defensives basket. For the geeks out there that like to look at the peer group analysis, this just tells you the blue diamond is the brand strategy versus large blend, large growth, and large value funds, which is about 3,000 funds. On a return basis, we tend to be above all the peers. We're never going to be the top dog in any time period, but we're always right at the top, so say the data, over returns. But more importantly, and something that I'm proud of as a risk manager, the Sortino ratio just tells you how do these managers manage through bad volatility, difficult times, and we screen really well. So if you have clients or you're an investor that wants great returns, but you don't want to get seasick along the way, this data by way of Sortino just tells you that we do pretty well versus 3,000 other funds in large cap from a risk management perspective. So just to summarize, consumerism drives every economy. It's 44 trillion in size and scope, so it probably demands some dedication in your portfolio. I can tell you through our research, you probably don't have much dedication unless you have a brand's allocation. So thank you very much for that loyalty. But I think there's a lot of opportunity for people to right size their overall portfolio, get some access to this global theme through these amazing brands, and then enter some maximum flexibility into the process that you don't have to manage. We do it ourselves. And so you can kind of set back and just watch and allow us to risk manage to know where to own the exposures across the globe. This isn't just U.S., although it will screen very nicely in the U.S. large cap basket. Currently, we're tilted towards growth, but that may not always be the case. That's the flexibility that we have. And right now, we have about 25% outside the U.S. across Europe and Asia with the global consumption theme. So that's all I have. I just want to thank everybody for coming today. And if there are any questions, we can certainly kind of open it up for questions right now. If you do have any questions about the thematic, about the portfolio that we have, about how we risk manage things, you can email me at Eric, ERIC.Clark, CLARK, at accuvest.com, and that's ACCU, V as in Victor, EST.com, and would certainly love to have further conversations. But at the end of the day, consumers are really flush with cash. They have pent up demand to go out and spend, particularly in the services category. I know so because I'm a consumer and I feel that way. So there's a lot of great businesses and a lot of great investments that we're trying to build for you in this fund and in the SMA, as well as in the UMA if you do model delivery. So if there are no other questions,
Eric, there was a question on holding turnover.
Yeah. So turnover tends to be a function of the market that we see. And I'll use a couple of years as an example. In, overall, we tend to, if you look at the portfolio that I have on the screen here, most, particularly the mega brands, we've held throughout the entire time. But we do trade around those brands when we get an opportunity. So as an example, if PayPal, if we have a 3% weight in PayPal, and PayPal, for whatever reason, goes down 10%, and we have the opportunity to load up on PayPal and maybe make it a 5% position from a tactical perspective, because the stock is now cheap and inflecting from a technical perspective, then we're going to do that. And so most of the time, the turnover tends to come from trading around current positions. And so, in a 2019 scenario, I think we turned the portfolio over maybe about 120%. Most of that came from trading around positions. The market has been pretty volatile over the last couple of years. This year in particular, it's been one heck of a rotational market. But in 2020, with the pandemic, the VIX index stayed over 20 from February till the end of the year. And so when the VIX is anchored over 20 on a multi-month period, your short-term trading opportunities are really robust. And so, the fund was up 45 last year in a difficult economy, but we not only we're in the right place because we pivoted to a lot of e-commerce and work from home brands and avoided a lot of the companies that were really struggling, but we also had an opportunity to trade the volatility with a small part of the fund. And so the turnover last year was probably a little over 200%, but it's strictly driven by market opportunities. We don't just trade to trade. And every month we do tax loss harvests along the way to try to lower our overall tax liability. And so when we have losses, we'll take some of those harvests and keep building up those losses for future gains. But the turnover can be high if the market's volatile and gives us an opportunity to trade around names that we like.
The other question was how many total holdings in the portfolio?
Yeah, there's currently 31. By prospectus, we can own 25 to 50. I tend to really like that 25 to 35, so you can really kind of cluster in the names that you really love the most. When we tend to go towards the 50, it tends to be, out of a recession, you probably want to own more stocks than less, and you probably want to own some of the lower quality names, because those are the ones that tend to come out of a slowdown fastest. If they can survive the slowdown, they tend to rip back quicker. But overall, we're about in that 30 to 35 names, which is where we tend to be. And again, 75% of the total tends to be those stable, predictable companies, which tend to have lower volatility. And then the rest are the more innovators, which can be a little bit more volatile, but are right-sized, smaller, with smaller weights.
Then the next question is, are you planning on tilting the portfolio a little more towards value in the future?
It's absolutely possible. If you read any of our blogs, in December, I wrote that I thought the most expensive part of the growth market, AKA the ARK ETFs, high revenue growth, not a lot of earnings, not a lot of cash flow, kind of forward 5-year outlooks. Those names to us just seemed really, really expensive. And so we pivoted about 30% of the exposure to some of those growth names that were really great winners from a work from home perspective. And we got more allocations to more core and more value. And so, I tend to I'm an interesting animal. I tend to like companies with growth characteristics, but I tend to like them to be high quality. So I tend to be more of a GARP, growth at a reasonable price investor. But we don't have a problem having traditional value in there. And we've had, Morgan Stanley and Goldman Sachs and CB Richard Ellis, American Express, and then some defensives that I don't even consider value names, but that are in the value indexes. So we're agnostic to being growth or value, and I don't certainly care if we make money in Procter & Gamble or in Amazon. So when we see the style factor work prove that value is really a place to be, and it's probably going to be driven by interest rates starting to rise on a more trending basis. I don't really see that currently, but if we did see that, we would certainly have more traditional value, cyclical value in there. FedEx, Union Pacific, UPS, some more industrials, financials. But for now, we really like this kind of growth at a reasonable price as the core, with a lot of the innovators that still we don't think are too egregiously overpriced relative to some of the ARK names, which are 50, 60, 70 times sales.
Well, on behalf of Kodiak Trust Company and Accuvest Global Advisors, thanks, Eric, for the presentation on the Dynamic Brands family. And we will see you in our next webinar. Thank you.
I appreciate it, everybody. Have a great summer.